All right, I guess it's about 2 o'clock and we'll start our webinar. This is a practical personal investing webinar, and I would like to welcome everyone that took time in this nice Sunday afternoon. One of the advantages of having a webinar is that we can enjoy sunny and very warm weather inside our house or wherever you are. It's actually very nice to have this environment. Just to remind you, this is part of a fairly long series of meetings that we had through the year. And webinar today is just kind of continuation or summary of previous meetings. And we had different titles, but in essence, it was a discussion about personal practical investing. So during this webinar today, we don't have much time, obviously, to go through the other discussions that we had through the year. But what I would suggest is that you go to the website, investorsupportnetwork.com, and there are two tabs that you want to check and read in details if you are interested in details that we discuss. One tab is presentations and recordings. This is the place where I should actually upload the information that we discussed during the meeting. And I said they should because unfortunately I don't have much time and I did not do a good job and I did not upload many of good discussions and information we have. I'm planning to do that in the next couple of months because I'm taking a little bit easier during the winter time. So watch out and check the website from time to time, and there will be more information. So today's presentation we'll discuss one of the series that we had, which is the investment ideas for challenging markets. So you'll find, again, go to Investor Support Network, and then you can go, let me just highlight so you can see that better. So this is the name, and then you go to presentation and recordings, and the actually series of this presentation will be right here. Let me just take off. So if you click on this tab, you will see all previous discussions we had about investing ideas for a challenging market. Now, and actually it started around June, July last year. And the purpose of that discussion was because based on my experience and many studies, September, October are months when typically corrections happen. So that's why I started this discussion. However, I think we all understand that markets are challenging all the time. And actually, I think there is some uncertainty in the markets right now. And I'm trading for about 20 or something years. And I don't remember a day when the market was not challenging. So I think it's a good subject to have a discussion about. So when you have a time and if you're interested, you can go through that presentation. Again, it's available on the website. And just to let you know, there are different points of view on the market, gurus and specialists. And I started that discussion by quotes from Schiller, who is a professor. I think he had some big awards for the work he done. And he said that there is a significant upside in the market. And as opposed to that opinion, there is a permanent bear or pessimist, Mark Faber, which says that in 2014 would have the worst crash, etc. And it doesn't matter when, you always will hear these different opinions. And so we had discussions about what can you do to protect yourself when the market corrects. And again, we don't have time right now. We did review some of the rules that William O'Neill had, etc. So what I like to do today is take a look at some of the practical application of our discussions, which is how you actually can perform a little bit better than the market. And it's a very simple strategy, which is basically based on volatility. So I will start today review and basically kind of follow up from this point, which is definition of beta, and we'll discuss low volatility ETF that you could use in these markets. So this is one area on the website that you can take a look, and there are many other presentations. The other tab that you want to look is investing ideas. And so if you click on that, I started to kind of upload some ideas that I have. These are not by any means recommendations, and you never ever should go and actually jump and buy or sell these securities or investments. It is just a starting point for you to consider. And again, there are a lot of good information. For example, I talk about cybersecurity in view of the recent threat that we have, and I do believe that these issues will become even more challenging, and a lot of money will be spent to protect government or private companies' assets from cyber attacks. So I did write this kind of suggestion when Sony website was hacked, and obviously Sony basically lost millions of dollars in revenues because of that issue. It came up to the President of the United States, and I'm sure that everyone today is very much aware of that situation. And these are some of the ideas that you could actually invest in companies. And what I'm talking here about, a new ETF, it's exchange traded fund, which symbol is HACK, very nice symbol, and that you could have a basket of different companies that invest in securities. Again, that's something for you to review if you're interested in this area. But what I like to do in today's presentation is to take a look at the most recent idea, which is the gold miners. So in essence, what we'll do today is review probably one of the first suggestions or ideas we had back in June, July, and the most recent one, and we'll see how that actually worked or it didn't work, and we'll go from there. I will just pause for a second before we start presentations. If you have a question, just use the chat window to send me a message. Otherwise, I will just start the presentation. Any questions? All right. So now it is important for me when I do this presentation to have interactive session, and this is one of the great things that I liked as many people attended in-class seminars is interaction with people. It helps a lot for me, and I will be more than happy to answer the questions and actually provide information that you are interested, not necessarily what I think should be presented. It is a little bit more challenging to do the same thing over the internet because I cannot see you and I cannot actually guess what is your opinion. For that reason, what I would like is whenever you have a chance to go to the website, and there is a tab called feedback, which is actually, it's an open kind of type questions or requests you can send. And I would really appreciate if you can send me anything that is on your mind regarding this particular webinar questions or any upcoming events that you would like to have in our group. So let's go straight to the actual review of one of the ideas we had. And before I talk about low volatility ETFs, I think we need to define what that means. And there is a scientific measurements of that volatility, and there are different ways of measuring volatility. One of them is VIX, which measures implied volatility, there is historical volatility, etc. What I would like to talk today about is a term called the beta, and it's different than other volatility factors. And what it actually does, it compares the volatility of particular security to the entire market. So let's say that you have a particular either mutual funds, ETFs, or stock, or any other instrument, and it goes in up and down certain amount. So what you want to do is compare how much that particular investment or stock moved relative to the market. So let's say that you had the stock that actually last week it was not very good, obviously, for most stocks, and we can say that average stock came down, let's say 2-3%. But what you want to do also is to compare how that relative to the market. So if the market came down, let's say 3%, and your investment came down 1%, that's one thing. But if it's the other way around, that the market was down, let's say 1%, and your investment portfolio or one specific stock came down 3%, this is somewhat different. So there is actually a mathematical or scientific way of measuring this kind of volatility, which is called beta. Now, so if your particular stock, let's say, came down, for example, 3%, and the market came down 3% as well, that means that your investment performed the same way as the market. And based on this mathematical formula, this beta factor would be 1, because it goes like 1-to-1 ratio. Now, if your particular investment that you consider would come down less than 1, that means it is less volatile than the market. So typically, if you look at the stocks that perform or have better or higher or lower than the market, most likely like traditional companies like utilities or real estate related companies, they would probably be less volatile than the markets. So their beta would be less than 1. On the other hand, typically like high growth companies like technologies and biotechnologies, which I do like, they are much more volatile, and for that reason, beta for this particular stocks investment would be higher than 1. Now, there is nothing wrong or right about beta being more or less than 1, but you need to understand what that means. And one of the things that probably makes sense is that depends on the market conditions, you can use for your advantage this measurement of volatility. So if you use logic, it would say that when the market corrects or going down, you probably want to have investment in lower volatility, because they would go down less than the market. So you would not lose as much as the market. And the other way around, if there is a very strong bull market, to take advantage of that, you probably want to have investments that have beta greater than 1, because they would perform better than the market. So from that point of view, if the subject of our discussion is dealing with challenging markets, obviously you want to have investments in low volatility, which is beta would be less than 1. And from a practical point of view, there are several ETFs, which are exchange traded funds, that you can invest, you can buy and sell them as any investment on the market. And one of them that I like is Bank of Montreal Low Volatility Canadian Equity ETF, and the symbol for that is ZLB. Now, just that you will have some good understanding and feel what kind of companies are in this ETFs? You can see it is Tim Hortons, Dollarama, Element Couche-Tard, which is like basically convenience store, Metro, again it's a food, Fairfax, BCE, Pembina Line, etc. So these particular, you can see that these companies like Tim Hortons, they would not move as much as other investments because it's fairly conservative. Even in a recession time, people would stop at Tim Hortons, and there are always lineups, as you well know, and they have their coffee. Obviously, if there is a deep recession, Tim Hortons would not have revenues as in good times, but relative to other companies, they probably would lose less revenue than others, and for that reason, their stock probably would perform better. That just based on the logic and theory, and being a practical guy, in a moment we'll see whether the theory actually worked in the recent correction or downturn market. Now, again, through all of my presentation, and this is a very important principle for me, I'm trying to be unbiased and non-promotional. So there are many other ETFs than Bank of Montreal, and even Bank of Montreal has different ETFs. And another example of low volatility or low beta would be ZLU, which is somewhat similar, but they hold more of utilities type of stocks, etc. Now, there are much more to it, and this is a list. Again, I don't think we have time right now to go through the entire list. Again, you can go back to the website and take a look and make your own educated decision, which one, if any, you would like to have part of your portfolio. But keep in mind there are many of them, XMU as you can see, and some others. And I meant the first example that I used, Bank of Montreal, ZLB. These are Canadian companies, but here you can see that it is American companies, which is basically low volatility, like Verizon, which is similar to Rogers. It's telecommunication company, PepsiCo, Merck, and Johnson & Johnson, which are very conservative, very stable companies that probably would perform better in a kind of downturn market than any other companies that would have higher volatility. And again, there is even a larger list of ETF, exchange-traded funds, which are based on low volatility, and you can actually find or filter through to specific area. For example, as you can see, it has like S&P 500, or you can decide that you want to have a mid cap or small cap low volatility. They actually have ETF which is low volatility in Japan, if that's what you decided to do. There is ETF which is JPMV, that holds low volatility stocks in Japan, if that's what you decided to have. So I think ETF is a good tool to start for kind of new investors, because in essence what you do, you buy a basket of different stocks instead of individual company, which very much reduced your overall risk, because if one company got in troubles, it would not affect your investment as much as if you had that individual stock versus a basket. Now, if you did decide to get deeper and do your own homework, you actually don't need to use ETF. You can actually screen or search the entire market and find by yourself companies that have low volatility or low beta. And one of the sites that I use from time to time is Finviz. This is the URL or address of this company. They have many good features, and by the way, most of it, everything that you need, what we'll discuss today, it's free. And one of the things they have is a screener, So if you click on this tab, and that's the window that you'll see. And there have many different parameters that you can use to find stocks that meets your criteria. One of these parameters is beta, which we discuss, and you can set it up that you, for example, want to have stocks that their beta is less than 1, under 1, and it automatically will show you all the stocks that meets that criteria, and you can then decide whether you want to invest in these particular companies. If we have enough time after this presentation and after the questions that you will have, I will open a live window of this website, and we can see how that actually works in real life. So let's get back to the, again, practical application. And when we started this series, I actually looked at the chart. A very important part of my investing kind of methodology is using both the fundamentals and the technical analysis. And I do look at the charts, and it's very important also to review your theory, or actually the hypothesis, let's call it, because you never know. The theory is one thing, reality is sometimes different. So what you're looking right now is the chart of the first example that we use, which is ZLB. This is the BMO, Bank of Montreal Low Volatility ETF. And there are three different charts that you can see overlaid on that display. This one, which is the candlestick chart, is the prices of that particular ETF, ZLB. And I started about July. That's the starting point. That's where we actually started our series of these discussions. The blue line represents the prices of XIU, which is very much the entire Canadian market. This is S&P 60, which represents the Canadian market. And the red line, that one, is XCG, which represents the energy sector in Canada. So it's all Canadian companies, two from different sectors, and one is the entire market. So we can actually compare and see how each of these investments work in last, I don't know, about 3-4 months. So the green line represents kind of starting point, and so the green numbers are the prices for the ZLB, but others are represented in a percentage. So ZLB, if you invested at that time, would be actually up about 31-32% since end of June, July last year. The entire Canadian market, in spite of the fact it came down, was up about 9% since July. And if you were invested in energy stocks, you know what happened. Unfortunately, for many Canadian investors, it is down about 30%. So just to summarize what that means, it doesn't mean that ZLB cannot go down. And actually, you can see when there was a correction in October, the low volatility ETF also came down, but it did not come down as much as the entire market. And overall, that period of time, that ETF ZLB performed better than the entire Canadian market, definitely much better than the energy sector. What we also can do is to take a look at, so this is a Canadian market, so we also can take a look at the US market, and one of the ETFs is SPLV, and actually most of them perform similar to each other. And on that chart you can see similar actually display, which is these candlestick represent the low volatility ETF, and the yellow line represent actually the S&P 500 market. So again, although the US market did not correct as dramatically as the Canadian market because the energy sector is not as big in US as in Canada, but it did come down recently. Regardless of that, the low volatility in this kind of condition actually performed better than the entire market. So again, starting from about end of July or June, July, as like reference or 0%, the U.S. market, the S&P 500, did about 2.4%, and the low volatility is up actually about 7%. So once again, that actually shows that when the markets are uncertain or if there are some challenging market, the low volatility ETF would perform better than the entire market. So that's basically the concept of low volatility. If you have any questions, I would suggest that you'll type in the chat window. And if you don't, I will continue to the second concept, actually the most recent, and then I will open the microphone for questions and discussions. So I'll pause for a moment. If you have a question for the low volatility, please type in. I will try to answer.